Welcome to Hive Investing. In this market brief, we follow the signal chain from macro pressure to sector movement, ticker signals, and paper portfolio decisions. This is educational research only, based on paper trading. It is not financial advice, and it is not a recommendation to buy or sell anything. By the end, you will know what Hive saw, what changed, what it avoided, and what risk it is watching next. Let's follow the signal chain.
Welcome back to The Explainer. So today we're diving into a really fascinating setup from Hive's weekly research report, dated May 28, 2026. Now, if you've been watching the tape lately and, feeling a little bit of whiplash, you're definitely not alone. Hive's data engine is basically picked up on a market that's showing us two wildly different faces at the exact same time. It's a tricky puzzle for sure, but we're going to map out the data and make sense of this whole thing.
And that brings us right to our central question. How exactly do you navigate a market with two completely different personalities? I mean, think about it. You look up at the scoreboard and you see massive momentum in specific sectors. It's printing green, it's pulling capital in. But if you glance down at the risk dashboard, it is flashing yellow and red warning lights, basically telling everyone to lower their voices and check where the fire exits are. It's a pretty profound paradox.
Okay, let's dive into this. Here's our game plan for today. We're going to cover 1. The cautious bull, 2. The signal chain, 3. Macro weather and sectors, 4. The paper portfolio, and we'll wrap up with 5. Hidden market risks. Let's get right to it. All right, section 1. The cautious bull, a market divided.
So, right out of the gate, Hive assigns a 60% confidence level to this cautious bull environment. And honestly, that 40% chunk of uncertainty, that is incredibly important. It means the system is explicitly telling us, hey, I'm not fully convinced this is a clear blue sky runway. It's leaning bullish, sure, but it's keeping one foot hovering right over the brake pedal.
And this brilliantly illustrates that underlying tension. Look at the strength side. You've got undeniable bullish momentum, a broad uptrend, rising corporate profits, and a VIX signaling a clear risk-on appetite. But then look at those warning lights glaring back at us. Major indices are looking technically overextended. You've got a bearish put-call options ratio, severe consumer pessimism, and get this, a GDP nowcast actively signaling economic contraction. So you literally have bullish price momentum fighting tooth and nail against severe macroeconomic pessimism.
Moving on to Section 2, the signal chain, cutting through the noise.
Now, when the data is this divided, you absolutely cannot just rely on your gut. You need a process. Hive uses 4 specific checkpoints to avoid getting faked out. First up, macro data. Second, sector evidence. We want to know if the whole group is participating. Third, it calculates individual ticker scores. And finally, number 4, the paper portfolio action. The vital takeaway here, market strength on a single ticker is just one piece of the puzzle. It's never an automatic green light. A stock has to survive this entire chain of evidence.
Real quick, before we look at the output of that signal chain, we need to be crystal clear about what we're actually looking at here. Hive is an experimental market research system. The actions we're about to review, they're part of a simulated paper portfolio. No real money is involved, zero. This explainer is strictly for educational and research purposes, just showing you how data can be structured. We're definitely not providing financial advice, we're just exploring how a quantitative system processes a really complex market.
All right, Section 3, macro weather and sectors.
Because as we know, individual stocks don't operate in a vacuum. I actually love this analogy from the Hive report. It says, if the signal leaders are the race cars, macro is the weather, the track, and occasionally the person waving a yellow flag. I mean, think about it. You could have the absolute fastest, most fundamentally sound company in the world, but if it's driving straight into an economic hurricane on a slick track, well, its performance is going to suffer. The macro picture is what keeps the single-name story honest.
And what's really fascinating here is the combination of these macroeconomic forces. Look at that CPI year-over-year number, sitting right at a sticky 3.95%. That's the kitchen table number, the one everyone feels. When inflation stays sticky like that, and you couple it with a 10-year treasury at 4.48%, it sets a way higher hurdle rate for corporate growth. It basically means companies have to work significantly harder to justify those high valuations. It completely alters the track conditions for our race cars.
Now, let's look at the G-Delt pulse and see how this builds out the picture. So G-Delt tracks the tone of global news. Price action tells us what capital is doing, sure, but the news tone tells us what the broader global narrative is. And right now, G-Delt is reading as completely neutral. Hive's logic here is super pragmatic.
If the global news tone isn't screaming in either direction, don't go inventing drama. Since the narrative isn't driving the bus this week, we're forced to let the hard data do the heavy lifting.
And that hard data is pointing very strongly to certain sectors. Notice how energy, the XLE, and tech, the XLK, are the clear leaders right now.
So why does that matter?
Well, if an individual tech or energy stock shows strength, it gets a whole lot more respect from the system because it's swimming with the current of its sector. But if a ticker is fighting against its sector's current, the system treats it as incredibly fragile.
Okay, let's move to Section 4, the paper portfolio, receipts and actions.
So let's check out the raw scan leaders first. AMD tops the list with a massive 0.984 composite score, heavily driven by strong trailing momentum. TSM and Broadcom are right behind it. But, and this is a big but, remember the warning from the report. Turning this table into a blind shopping list is a terrible idea. Pure momentum, as fun as it is, can be the market equivalent of a crowded restaurant with absolutely no fire exits. It looks like a great party right up until someone yells fire, and then everybody gets trapped trying to squeeze out the same door at once.
So how exactly did Hive translate all that into simulated action? Well, check out the reduced exposure to major indices like the SPY and QQQ, and even Apple. You might be wondering why cut those, because despite the upward momentum we just talked about, they were flashing as technically overextended against that really tricky macro backdrop. But on the flip side, the system actively added exposure to XLE. For energy, the sector strength and the price momentum actually aligned perfectly with the system's risk parameters.
So, the crucial point to take away from this is that the important part isn't the verb. It's not just about bought or sold. The important part is the sequence. One really strong score on a stock like AMD, that just starts the conversation. To actually justify a simulated move in the book, that setup has to survive the macro check, then the sector check, and the concentration risk check. It has to run the entire gauntlet before anything happens.
And that brings us to our final part, Section 5, Hidden Market Risks.
Because look, the system is cautious for a very good reason. Even while energy and tech are out there pushing the market higher, there are some very specific storm clouds building on the horizon. Just look at this watch list of warning lights. We've got deep consumer pessimism in the UMich sentiment data, which means everyday people are really feeling the pinch. We've got a GDP nowcast screaming contraction, which totally contradicts the broader, rosier economic narratives. And options traders, they are actively buying downside protection. But I want to draw your attention to that very last bullet point, maritime supply chain stress. This one is critical, guys. Shipping stress impacts transport costs, which then impacts energy prices, which, you guessed it, ultimately shows back up at the kitchen table as inflation.
And just how acute is that maritime stress right now? Well, take a look at this number, 0. In Hive's latest sampled window for the Persian Gulf proxy, they tracked exactly 0 vessels, 0 tankers. Think about that for a second. You don't need a breaking news headline declaring a strait closed to realize that an empty shipping lane is a building baseline for massive supply chain and energy stress. The hard data is literally seeing the bottleneck way before the news cycle even picks it up.
So, what does this all mean for the tape going forward? The practical risk here is that the market just keeps rewarding a very, very narrow set of winners, all while the macroeconomic backdrop slowly gets less and less forgiving. Always keep this in the back of your mind. A market tape can look incredibly calm and incredibly profitable right up until the exact moment it abruptly stops being calm.
Which leaves us with this final, provocative question. Can single-name momentum actually survive a mixed macro tape? I mean, can these high-flying tech and energy race cars really keep driving forward at top speed if the track gets slick and the yellow flags start waving? That is the defining question for the weeks ahead. If you want to see how this data continues to unfold, I highly encourage you to dive into the full report over at the Hive Investing Substack. Thanks so much for joining me on The Explainer today, and as always, keep your eyes on the data.